All right. Okay, good evening, everyone. Thank you for joining our webinar tonight. So my name is Abigail, and I will be your host tonight. So I hope all of you had your dinner, or if you are having your dinner, you can still join and listen and also learn as much as possible. All right, so first things first, let me just do a sound check. If you can hear me loud and clear, you just click yes in the poll. Yes, all right, I saw it. Yes. Okay, awesome. Okay, so now before we start, here's a disclaimer. All right, the content that we share tonight is just for general information and educational purposes. It does not constitute any recommendation to buy or sell any investment products. Okay, and just a little bit of background about our company. So our company is called Phillip Capital Sdn Bhd, and we are incorporated in the year 1995. So our company has been around for close to 30 years, and we are also a wholly owned subsidiary of the Phillip Capital's holdings. Some of you may know that we were formerly known as the Phillip Futures, but as we grew and expanded our services and product offerings, we have since renamed and rebranded ourselves as Phillip Capital. Okay, and apart from that, we are also a trading participant of the Bursa Malaysia derivatives, the participating organization of Bursa Malaysia Securities, and a holder of the Capital Market Services license. So in short, it just means we are a legal and regulated broker in Malaysia. Okay, Phillip Capital has offices across Malaysia. So our mother company is from Singapore, but our headquarter in Malaysia here is based in KL. And we have 11 branches in both East and West Malaysia. So our offices are actually called the Phillip Investor Centers. And if you are in any one of these cities, you are welcome to drop by our branches to inquiry about investment-related services. Okay. We are very honored to have received the Bursa Excellence Award for the past many years. So last year, we have also been awarded as the first runner-up for the best retail derivatives trading participant, and also the second runner-up for the best overall derivatives trading participant. So we continue to upgrade and provide the best that we can to serve our clients better. And we also want to thank you for all our clients for their support all these years. Okay, Phillip Capital has a wide global network. So we have offices in 15 different countries as located in the map. As such, we also have an international client base. And for futures trading, we provide products listed in global exchanges from the US, the Europe, Japan, Hong Kong, Singapore, and so on. So with our global coverage, clients can trade both local and also foreign products within the same platform. Okay, yeah, this is the products that we offer. So we have three main categories. So the first one is futures, which include diverse markets like the equity index, the agricultural futures, metals, energy, and also interest rates futures. And then the next one is equities or stocks. Okay, so you can trade Malaysia shares, US, Hong Kong, Singapore, and Australia shares with us. And other than just shares, we also our clients can also trade ETFs, warrants, and also IPOs here. And then the third one is the contracts for difference, or also known as CFDs. So we offer local Bursa shares and US shares CFDs, but those who wants to trade like the US indexes like Dow Jones, S&P, and NASDAQ, we also offer the index CFD. All right, so for futures and CFDs, they are called derivatives product that allows you to trade bi-directional. So it means you can trade both ways, when the markets go up and when the markets go down. So if you are someone who likes to take advantage, right, when the market is bearish, so you can look into futures or CFDs to short using these two instruments. But if you are an investor, right, you like to collect dividends, then stocks are definitely suitable for you to explore. And our rates for the foreign markets are also very competitive as well. Yep. So yeah, why choose us as your broker? All right. First, Phillip Capital is an award-winning and also multi-asset broker. We are well established and recognized in the market. And secondly, we offer 24 hours broking and execution support. So if you have issues regarding your trades and account, you can call in our link desk and we have dealers ready to assist you. So we also provide advisory services on what kind of products you like to trade and how you can get started. Yeah, you can always contact our dealers to assist you on this. And next, we send out latest market news to our clients on a daily basis, so you can be sure to get the latest updates. And just now, as I mentioned, our clients can trade a wide array of products through our platform. And lastly, we also have an online account opening, which is very convenient. Okay, and apart from what I mentioned just now, right, we also provide this free one-to-one coaching, and we also often conduct free seminars and webinars. And lastly, we also have an account that is free that you can open and kickstart your trading journey with us. And for the free one-to-one coaching, it's mainly tailored for our beginners who who need some guidance on introduction to like futures, stocks, or CFD trading, or how to use the platforms. So if you want to have this kind of a session, we can arrange an appointment to guide you for free. And if you are interested, you can always drop us a message or an email on this to make the appointment. Yeah. And also at Phillip Capital here, we constantly provide educational resources for our investors. So you can check out our upcoming seminars and webinars by scanning the QR code here. So we always do invite like speakers from the industry to give market updates and insights. So it is a good learning opportunity for traders and investors. So feel free to check them out and join us for upcoming events as well. And this is for those who trade stocks. So we conduct this weekly market calls. So you can join our research team, right, as they share their market views and updates for newly published reports every Monday at 11:15 a.m. Okay, or if you want to learn like technical analysis, right, how to spot entry and exits, then this is for you as well. Our analysts will do technical analysis on live counters every Monday night at p.m. Yeah. So these calls will be done over Zoom online. You just have to scan the QR code and look at the schedule. Okay, so this is our online account opening site. You can open an account for stocks, futures, and also CFDs, all done via online, which is very convenient. So if you are interested, yeah, you can just scan this QR code and it will take you directly to the online application, and it takes you about 10 minutes to fill up your details and you'll be done. Yeah, so if you ever need any assistance, you can also look for us or drop us any inquiry on how to open an account. Okay, now onto the trading platforms. So this is the platform that we use for futures trading. It is called Phillip Nova. So this is a web-based platform and it is very simple to use. So we have a mobile app for Apple and also Android devices. And our platform is equipped with a wide range of technical indicators, live charts, market depth function, and you get access to both the local and also foreign products. So if you are not our client yet and you want to try out our platform to see how it works, the interface and all, we have a demo account for you to try out. So yeah, this is basically the demo account code lah. You can check it out there. Okay, and then next one is for stocks trading. All right, for stocks, the platform we use is called Poems Global 2.0. So yeah, we had an upgrade to 2.0 lah. Okay, our platform offers advanced trading tools such as technical analysis charts, stock analytics, news, and also I think this is a very well-liked feature, which is the analyst commentaries. Okay, we also have this customizable alerts that provide users with an edge in making the informed investment decisions. So whether you are new or experienced investors, this is a well-equipped platform for you to use. Okay, and lastly, this is the platform for share CFDs. Okay, so it's called the Phillip CFD Trader. And this is pretty much how it looks like. You can customize your layout, see the charts, price quotes, and position all in in one screen, which is also very easy for you to manage your trading. So yeah, that is the platforms that we have and we offer. And now moving on to our promotions. Currently, we are having a few promotions. So the first one is the Trade and Earn with Philip. So you can stand a chance to win exciting prizes like the iPad, AirPods, Apple Watch, and also up to 1,800 touch and go reload pin when you start to trade any product with us. So it can be futures, stocks, or CFDs. And of course, the more you trade, the more rewards you are likely to get lah. Okay, so this promo will run until end of this year. So yeah, if you would like to participate, you can just scan this QR code for more information about the TNC and all. And then this is the next one, which is the FGLD Gold Futures Trading Challenge by Bursa Malaysia Derivatives. So you can trade gold futures and win up to 20 grams of the actual gold, okay, based on the tiers here. All right, so that, yeah, this is the grand prize. And this campaign also will run until 31st of December. And if you already have an account with us, you can start trading and participate in this campaign. And for more TNC, you can also refer to the Bursa's website here at bursamarketplace.com/FGLD. Yeah, it's a Bursa's gold futures. Okay, so yeah, that is all for our company introduction. And now, before we dive into our topic, I also like to introduce you to our speaker, David. So yeah, David is a proprietary trader with IcebergX Sdn Bhd, and he is well versed in the commodities and also the indices market like FCPO and FKLI. So he does extensive research on these markets and beyond, even beyond these markets as well. So other than that, right, David also conducts regular public seminars relating to futures trading, and he provides these market commentaries to local media like The Star, Business Times, and The Edge in this role. So I'm sure many of you are also familiar with David and his expertise in this field already. So yeah, if you have any questions regarding the topic tonight, please drop them into the question box, because we will have a Q&A at the end of the session where David can answer your questions. So without further ado, right, let me just welcome David.
Yeah, hi. Hi, Abigail. Can you hear me?
Just screen to you. Yeah, hold on, yeah. Yes, I can hear you. Okay. Yep.
Okay. Are you able to see my slide now?
Yes, I can.
Okay, yeah. Okay, thank you, Abigail, for the very kind introduction. So just before I start, just like to thanks Philip Capital for inviting me back again to talk on today's topic entitled FKLI last quarter outlook, and also some basic trading technical strategies that we can navigate the market with. So just before I start, as usual, I think just to reiterate what Abigail has mentioned earlier, is basically, I think presentation today is purely for education purpose, and opinions as reflected here today is mainly my own. It doesn't reflect opinions from Philip Capital or even from the exchange. And you know, FKLI is mainly a futures product. So dabbling in the futures market does involve risk. So make sure you consult a licensed representative. I believe, you know, in that regards, Philip Capital will have, you know, all the personnel that is well in depth in the market, and they probably can able to guide you and assist you in your trading journey. Now, I think in the next half an hour or so, I think the key thing is that when you talk about FKLI as an index market, you know, besides the crude palm oil futures market that is heavily traded on the exchange, we also have another product that is well liked and also traded quite many by the local participants. It's mainly the FKLI index futures market, which track very closely with the KLCI market itself. So if you are someone that is in you know, the stock market, currently, I think KLCI futures market will be something that you can you know, point your direction with. And for the simple fact that futures allows you to both long and short, which means that you can actually take a short position in the market if you have a view that the market is going to head further down. So I think that's the flexibility of using the futures as an instrument. So you can definitely express your view both either you're positive in the market or you're negative in the market. So obviously currently we have a lot of headwinds in the market. Malaysia is definitely not susceptible to that. I think you just look at the news flow that's coming in. There is a lot of headwinds that's coming into the market, and therefore that creates a lot of volatility in the market. So as a trader, we definitely love volatility. It's a matter of how we navigate through those throws and peaks, and obviously find opportunities in that regards. So I just want to start off with just looking at some of the key things that we look at especially when we look at trading FKLI. Now Malaysia is definitely not susceptible to same as any other economies. It's also pretty much dependent on any other external market developments, especially from big economies like the US and China. So anything that is happening in those economies is definitely going to reverberate to Malaysia economy as well. So in that regards, it's going to have an impact if you are trading the FKLI. So we are almost end to the quarter. Last quarter usually is very interesting when you trade index because normally there is always the effect of window dressing coming into play, the seasonality that's coming into play. The key question is that given all these external headwinds that we're seeing right now, are we still able to see those seasonality impact to kick in again this year? So it's critical to watch. I think the next couple of weeks or so is going to be quite volatile in the market. As geopolitical tensions also intensify. So all these factors actually creating a lot of volatility in the market. Now, again, I think when it comes to volatility, traders do love volatility. So be prepared and embrace the volatility. And obviously, if you are navigating the market, you must make sure you have a trading plan in place. So the last bit or the second part of this webinar, I'm just going to share with you a very simple trading plan that you can use, especially when you're trading an FKLI market. Now, every trading plan, there is always a necessity to make sure that you have predetermined stop loss. If you don't have a plan in place and you just go with the market, is always a very dangerous proposition. So make sure that you must have a trading plan in place before you actually embark the journey of trading the FKLI market. Now, I'm just going to kickstart with just looking at how things are looking at on the external front. I think this year, when it came into 2023, beginning of this year, I think people were quite optimistic in the sense that we're just over the pandemic. We are just coming out of pandemic with so much optimism that China is reopening, US is reopening, across the world is reopening. In fact, even in Malaysia. So when economy reopens after a severe pandemic, things will start to look good. Now we have a strong momentum coming into 2023, but I think that momentum has sooner or later been quite lackluster and quite sluggish. Now going to 2024, things are not looking that bright. If you just look at what IMF has projected, it looks like next year is going to be quite challenging in the sense that a lot of major economies will probably face a lot of severe consequences with their economic situations. So be prepared. I think not only domestic front, the external front next year is also going to look very choppy. So if you are in the market, I think next year, easily the first quarter or the second quarter, we're definitely going to see a lot of volatility in the market. So be prepared. I think in terms of outlook, IMF is really projected that next year, at least the first quarter, is going to look quite bumpy, and it's going to create a lot of chaos between other external markets. Now, the funny thing is that despite we're seeing overall there's negativity when it comes to sentiment, but not all countries are the same. Now, US is a clear exception this year. I think 2023 is the best year for the US markets in so far after the pandemic. Now, the reason is simple. I think US is actually on the trajectory of growth. But then again, the key thing that is actually dampening the sentiment in the US market is clearly on the interest rate rise. Keep in mind, we have been enjoying a decade of low interest rate environment, especially in the US market. Within a short span of about 15 months, we have seen the interest rate in US expanded from quite on a 0% level up to 5% level on a very drastic pace. Is bound to break something in the end of the day. So I think that's what US is going to face going forward with high interest rate environment as an avenue to combat inflation. I think that's going to create a lot of pressure in a lot of markets. and I think therefore that's something to watch out for. Now, if you just look at growth per se, I think US is clearly on the top, given that their growth projection seems to indicate that possibly there's still room of growth. Now, besides US, I think the next big market, especially China, on the other hand, seems to show otherwise. I think China this time around seems to show quite a weak economy throughout the whole year. Now, I think it's mainly because of the property crisis that's happening in China. I think that will probably bog them down in terms of their growth. So if China continue to not show any sign of strength, that will also put a lot of pressure on our Malaysia economy, because keep in mind, China is a very big major trading partner with Malaysia. So if China is not buying, China is not demanding much, and this will also affect commodities market, commodity space. Eventually, this will also affect Malaysia economy in other ways. So keep in mind, I think as we enter into 2024, we always economists that is actually projected to do well, and they keep revising the outlook to the negative side. Things may not look that bright ultimately as we enter into 2024. Now, I think the key thing about this is that inflation was a major theme late last year and also this year. Why is because if you just look at commodity prices, whether it's crude oil, whether it's palm oil, those prices last year was traded at almost at an all-time high, especially for palm oil. It went as high as 8,000 ringgit per ton. We have not seen those prices before. Now, all this will definitely create a lot of inflationary pressure. Now, central banks will have to react. If inflationary pressures are very strong, consumers will definitely feel the impact. They don't have enough spending power because inflation erode their consumer or rather their spending power. So eventually, I think with central banks will have to step in, and as a way to combat inflation is the way to hike interest rates. So you just draw an example from US interest rate as a classic example. It was doing 0% or close to the floor pretty much for a whole decade. And now suddenly with a hike of interest rates from 0 to 5%, it's actually a very drastic move. They have to do that. Federal Reserve have to do that as a way to combat inflation, because if they don't hike interest rates, they don't slow down the economy, inflation will go berserk, and they don't want that kind of scenario. Now, the key thing is that will inflation start to normalize in 2024? It's a very tough question, because now, if you just look at commodity market as a whole, the major commodity price which everybody is looking at is actually crude oil. So really, if crude oil sustain at this level between the $70 to $90 per barrel, it's very tough for inflation to come down. So I think inflation is going to be a very classic theme that is going to play around at least for the next few quarters. And this will definitely put a pressure on central banks, because as long as inflation is high, central banks will just have to maintain a high interest rate just to temper down the demand. So I think really going forward next year with high interest rate, we are going into a year where it's high interest rate environment. It's going to be very pressuring for a lot of asset classes, especially in the equities market. So do watch out if you're trading the equities market or you're trading the equity space. Be on the lookout, especially when interest rates remain very elevated. It will definitely put a lot of pressure when it comes to stock performance. Now, if you look at this regards, even though month-to-month CPI inflation, the growth seems to have tapered down, they have slowly softened, but then again, the level is still pretty much elevated. Keep in mind, Federal Reserve in US maintains a target of inflation target at 2%. Right now, they're doing about double that amount. So really to bring it up to 2%, it takes quite a while for it to reach those levels. If you look at it, I think it's as long as crude oil price remains very high, it's very tough for Federal Reserve to hit the target. And with geopolitical tension that is getting intense day in, day out, it's also again going to be another going to be adding fuel to, especially for crude oil price performance. With the Middle East tension that's going on, I think this is something that's going to put pressure, for commodity prices. So going into 2024, it seems like, as long as inflation remains very stubborn, interest rate is definitely going to be on a higher level, and that's where it's going to be pressuring markets at the end of the day. Now, besides looking at interest rates, if you just look at some of the key indicators, economic indicators in the US market in particular, we can clearly see that numbers are not looking good. First thing first, the interest rate that is very high, obviously consumer will feel the pinch. And one of the ways that consumer feel the pinch is that the servicing cost of the loans. So keep in mind, they used to enjoy almost close to 0% interest. So a lot of consumers will pile on debts. And when interest rates start to rise dramatically and quite rapid pace, that will definitely affect consumer sentiment. So you can clearly see, I think, if you talk about housing market in US, those numbers are starting to fall into negative territory. So it does indicate that the slowdown is happening within the scene in the US market, and eventually it will translate to the global into an external and wider economy. Now, if you look at other economic surprises, which is an index that they track quite closely, even that also showing you that there's not much economic surprises, or rather there's not much positive surprises when it comes to certain economic indicators. So all these are pointing to you that things may look good on the external front, but really I think in the internal economy, things are not looking as good as it is. Now, besides that, besides the housing sector in the US market, you just look at company earnings in the US market continue to also underperform. And this is crucial because if you are trading the US index market, if companies are not reporting good earnings, usually that will translate into poorer performance. And eventually that will also bring down the index as well. So be on the lookout if you are trading, whether it's the US market or whether the Malaysian market, as companies starts to report quarterly reports, if there are those reports or those profits are not in line or they miss their estimates, that will really tell you how the economy is doing. As long as companies are not performing as it is, that also does indicate that the economy is also losing its momentum, and that's one of key crucial signs to watch out for as well. Now, I think this is a very interesting chart. Here we have basically the US interest rates against the Dow Jones market. You can clearly see once the US interest rate starts to hike up, we have seen the earlier positive momentum, but that slowly start to fade off. Keep in mind, in historical basis, when you have low interest rate environment, that usually benefit the stock and equities market. But when you have a high interest rate environment, that usually put a lot of pressure on the market. Now, when it comes to interest rate, this is what is crucial. A lot of people now is just anticipating when Federal Reserve will start giving the signal to cut interest rate, because when that happens, at least the market will have a breather, and consumer may start to have confidence back in its own economy. Now, if you just look at where the statistics is, just the numbers are, I think really the US Federal Reserve is just looking at inflation numbers. If inflation numbers are still very stubborn and it's not coming down as fast as they want to, I think that will be a good indication of how rates is going to go. As for now, in fact, if you just look at where interest rate is and where the inflation level is in the US, it looks like we are coming to possibly another hike towards the year end. If not, it's probably going to be maintained at this high level of about 5% for at least the next few subsequent FOMC meetings. So it's crucial, with rates that is very elevated and with changes environment that is especially in the inflation front that's very stubborn. I think that's something that is going to be, we have to watch out for as we hit into 2024. Now, besides housing market, besides economic surprises or earning surprises, I think next key thing is that if you gauge the US economy front, is basically to look at consumer sentiment, and one of the ways is look at consumer spending. Now, historically speaking, when you have high interest rate environment, normally is a dampener for a US consumer when it comes to spending. Obviously, is when you have high interest rate, that means you are paying higher interest, and your credit card interest will also be high. So that will put a lot of spending offhand, and that will translate into slower economy. So all these numbers does indicate that the high interest rate environment that's where we are seeing in the US market is slowly inching down to the bottom line, and eventually that will have an impact for its own economy. Now, this is a very interesting chart. What we have here is basically we have the margin debt that's taken by consumers when you buy any of the US stocks. Keep in mind, when you have low interest rate environment, consumers like to buy stock markets with debt, because the cost of servicing your debt is actually very cheap when you have a low interest rate environment. Now things start to change when you have high interest rate, and you can clearly see right now that there's a lot of deleveraging happening in the US stock market. You can see the blue line here, which is showing you the depth of using debt to buy equity, or rather using debt to purchase stocks. You can see that the margin debt clearly has been actually on a downtrend, because that does indicate that the high interest rate is actually pressuring consumers to actually deleverage, which means that sell their stock holdings and do not use any of the margin facilities, because with high interest rates, obviously you definitely demand higher return for your stocks to cover the higher interest that you're paying. So I think we can clearly see whenever there is deleveraging happening in the debt margin debt market, that will really push down stock prices as well. You can see many of the occasion, I think back in 2019, a lot of consumers deleverage, and that also causes market to eventually to plummet as well. So this time around is also slightly interesting. We have seen the equity performance in US market seems to hold well, but eventually I think it also start to plummet because consumers are not participating as much in the equity space because of the they are not taking debt, again because of the interest to finance the debt is actually very high. So eventually I think this is a very good indication to where we can use it to reflect where the market is going to head. As long as consumers are not partaking debt because of the high interest rate environment, eventually equities will find a bit of limited upside. Now, consumer sentiment, I think it's worth mentioning again. Looks like really retail consumers in US is feeling the pinch. So again, I think these numbers does indicate to you that things are not looking as well and as rosy as what the market is showing. As long as these numbers continue to be showing you negative or weaker sentiment, it's definitely going to pressure the equity space to in the longer run. Now, coming into the corporate debt, this is another interesting point. As we have seen and very clearly that the interest rates are very high, which also does indicate that consumers are affected. Now, if you just look at how companies are also evolving, you can clearly see despite the high interest rate environment, not most of the companies in US is actually still sitting on a very fixed loan rates. And the fresh loans are also obviously based on a very variable rate, which is closely affected by, especially in a high interest rate environment. But a lot of companies, especially in the S&P 500, are still sitting on a very fixed rate loan environment. So that does indicate that despite the rising interest rate they're seeing in the US market, it may not affect much ultimately to the bottom line of the US companies. But again, if their margins are being compressed, sales or demand are slowing down, revenues are coming down, that also tell you that eventually they have to buckle down. So these are something that we have to watch out quite closely. If companies are not doing well, usually that's the first sign of crack in the economy, and that will really push down the equity space. Now, these are actually very clear cut. I think these are very clear barometer to really gauge how a high interest rate environment is going to affect the market. You can clearly see the bankruptcy rate for companies in the US market is actually rising. Obviously, we have seen, during the pandemic, there is obviously as a high percentage during the severe pandemic at the start of the COVID-19 pandemic. But this year alone, I think we can clearly see the numbers are actually inching higher. So it does indicate that things are slowing down quite dramatically, and interest rates are pressuring a lot of markets, and eventually that will also translate into higher bankruptcy rates as companies couldn't finance or refinance or couldn't even afford to pay the loan interest. I think that eventually will spell trouble for the particular sectors. So these are all pointing to you that there's weakness in the US economy, and eventually that will translate into weaker growth, and that will spell throughout the whole economy. Now, this is actually very interesting. What you have here is that if you just look at how the household net worth has been over a couple of decades or so, and if you compare where the US GDP, there's clearly misalignment. The US GDP growth has not been substantial enough. In fact, a lot of the net worth that is currently being stated in the market is still mainly driven by debt. If the debt market starts to collapse because of the high interest rate pressure, I think that will spell a lot of misalignment in the asset classes. So clearly we can see bond markets are plummeting because yields are rising. Equities markets are also softening. So I think eventually there is bound to be adjustment in the market. Now, this is not foretelling that it's going to be a crash in the market coming soon. But what it does indicate to you is that you can't stay on this path in the longer run. There's bound to be an adjustment in place sooner or later. So eventually, whether there's the equation will be is whether the US GDP can continue to perform very well, or the household net worth will have to readjust, which means that whether their net worth will be in property market or in the stock market, they're bound to have some adjustment. So I think that's where there's a huge misalignment, especially in the US market, between these two factors. So be on the lookout. I think this is on a longer run basis. Federal Reserve has been saying we can achieve soft landing. Now, is it very possible? It looks like the situation gets very unlikely. It's more of a hard landing that we are seeing as we go quarters to quarters ahead. Now, so that's pretty much on US. Now, US ultimately does shows that it's finding it very difficult when it comes to its own economy. There is a lot of red flags that is actually showing you telltale signs that the economy is actually slowing down. Now, moving back to our front, Malaysia front, things are starting to look at also very, I think overall, if you just look at Malaysia in general, it's actually been softening for quite a long period of time. If you compare the three major indices, you compare the KLCI, the top 30 counters, the index market, and you compare the mid cap, the FM70, and you compare the ACE market. Now, ACE market, back in 2021, 2022, as we progress in the mid of the COVID-19 pandemic, they were pretty much outperformers. There is a lot of small cap companies actually done very, very well. But again, those performances were only short-lived. Then after, you can see ACE market pretty much will actually plummet to levels that way below the pre-COVID-19 levels as well. Now, if you just look at the FKLI, the top 30 counters, and the mid cap, recently the mid cap starts to outperform the top 30 counters. So it does indicate to you, or it does shows to you that a lot of Malaysian companies, especially the top 30 counters, are also being influenced by the external front. As long as external economies is not doing well, eventually that will also affect a lot of companies that is that especially in the top 30 counters that's very exposed or quite diverse, have a quite wide or quite diversified pool of operation across the world. So really, I think Malaysia companies are also quite influenced by what's happening in the global space. So that eventually will also affect the index as a whole in totality. Now, there's always a saying, whenever we want to trade the Malaysian market, the best gauge we can use is to look at the US market. So if the overall the US market performs well, we can assume that the Malaysia market will tend to follow. Now, this relationship does hold before the COVID-19 pandemic. You can see there's actually quite a close relationship between the FKLI and obviously the US Dow Jones market. Then I think as we head into the peak of the COVID-19 pandemic, things start to change and take a turn. We can see there's a clear divergence between both markets. So US Dow Jones continue to outperform, not only for FKLI, I think many of other major markets as well, because US is running on a very different path. And you can clearly see the divergence is actually causing a lot of headache. If you are trading based on this relationship, most of the time you will easily get caught. So I think pretty much if you are trading based on a historical perspective, it's actually a very tough proposition. Now, historical basis does serve as a guide, but it doesn't mean that it's a proper strategy that you can use or you can embark on. So keep that in mind. I think right now you can clearly see the divergence between FKLI and US Dow Jones market is still pretty much wide. So there's no clear relationship between both markets. In fact, I think US Dow Jones is actually still trading on still well supported, but it's not the same case for FKLI. So keep that in mind. If you are trading with FKLI, you can no longer use Dow Jones as a guide. Historically speaking, in those days, both of the markets move quite parallel, but now I think both markets actually is quite diverged in certain ways. Now, I just want to share with you also, just by comparing the FKLI together with Dow Jones and also one of the key commodity, which is the copper market. The reason why I put copper in as a basis of relationship is because if you notice that copper as a commodity is actually very much driven by the global economy. So if the global economy is picking up speed, normally you expect copper prices to be strong, because copper is actually an industrial metal, and industrial metal is mainly used whenever we have expecting a higher industrial output. So when you're expecting higher industrial output, normally you expect higher or bigger copper consumption, which will eventually push up copper prices. So you can clearly see there's a strong linkage between copper market and also pretty much to a certain extent the FKLI. So here you can see the black line is actually a FKLI, and your copper market is actually a red line. You can see that when copper market starts to weaken, the FKLI market will also starts to weaken, and the copper market, when it gains strength, then eventually FKLI will also gain strength. So there's quite a close relationship between the copper market and also the FKLI market. I think this is in relation to the copper position as an industrial metal, which does indicate to you how the global economy is going to perform. Now, if you compare copper with other markets as well, whether other indices, especially the China indices, it also has quite a strong positive relationship, which means that that's why copper, in other words, are called as a Dr. Copper, because it really does relate to you how the global economy is going to perform through its prices. So if copper prices remains quite strong, it does indicate to you there's strong demand for copper. Eventually, the global economy still has some leg to grow. But copper prices starts to come down, that usually indicates to you there's weakness in the market, especially the global front. So you can clearly see, I think, if you just look at where copper prices is, there's actually been a downtrend. It's been trading from below the $4 mark for quite some time. So it shows you, I think, eventually the global market is actually softening as we head into next year. I think one of the best indication to see whether there's strong momentum in global economy is just to look at copper prices, and that will probably paint you pretty much a picture of where the global economy is heading. Now, given that Malaysia economy is very commodities driven, we have obviously we are very strong driven by crude oil prices and also CPO prices. So if you take at Thomson CLI's index, which is a commodity price index, as a gauge, you can clearly see that whenever commodity index starts to perform, the FKLI will also start to perform, which it does indicate to you Malaysia is actually very driven by commodity prices. Now, the funny thing is that after 2022, there seems to be a slight divergence. There's a couple of factors that possibly can explain why this divergence happens. First thing is that Thomson CLI index are heavily biased towards crude oil price. Despite we're seeing strong crude oil price, Malaysia should eventually benefit, but we don't see that. The FKLI performance that shows to you that there's no linkage in that regards. So it's quite puzzling. I think mainly it could be because CLI index is very biased towards crude oil. So when there's a rally in crude oil market, you push up the index quite dramatically. But FKLI, to a certain extent, it does affected by high crude oil prices, but there's also other sentiment that or other factors that actually could be a dampener for FKLI performance. So I think that's also telling you that the relationship to a certain extent it does hold, but there's also period where, or whether there's certain circumstances where the relationship doesn't hold. So keep that in mind. I think it's interesting to watch. Despite we are seeing strong commodity prices, it doesn't seem to show that Malaysians tend to benefit. So it's very puzzling in that regards. But as a trader, if you want to trade based on index relationship, commodity index relationship with the FKLI performance, it's getting difficult because the linkage doesn't seem to show any positive linkage between both the factors. So I think that's something for us to watch out for. Now, I think besides looking at commodity prices, Malaysia is also well intertwined with China's performance. The reason why Malaysia has been actually not performing so well in recent times is also because of China's economic performance. So you can clearly see, if China starts to slow down, Malaysia will definitely feel the impact. Here you have the black line, which is the China manufacturing index. So it does indicate there's a weakness. Recently, there's past few quarters, there's weaknesses in China manufacturing index, and therefore actually pushes down or putting pressure on the FKLI performance as well. So Malaysia, to a certain extent, is actually very intertwined to China's economy. If China economy continue to stay weak, that also tells you that Malaysia front will also find it very difficult to go any higher. So that's one way of looking at, or whenever you look at trading in Malaysia space, you can actually relate to China's economy. Now, China on its own is actually battling a lot of domestic issues. I think the major one is always a property crisis that's happening in China. That this property crisis is actually very long standing, and it's not an issue that they can resolve immediately. It does take time. It requires a lot of effort. But the only positive, or the only positive sentiment that we can gather from what is happening in China right now is that the government is very committed to resolve that issue. Despite property issue is an overhang, and again, it's not an overnight thing that you can resolve. It will take time, and I think the China government, as long as they're committed to be trying to resolve the issue, I think that tells you a lot. So eventually, I think China sooner or later will try to engineer growth within its own economy, and hopefully that will also benefit the rest of other major economies. Now, why Malaysia is so depending on China, you can clearly see, I think China is one of the largest trading partner. Now, besides China being a very large trading partner, Malaysia also does trade with other external parties as well. The funny thing is that I think this year, the growth within other external parties has actually been very sluggish. So it's not only China, even exports to Japan, Indonesia, even our neighboring Singapore has actually been slower this year. So it does brief the overall sentiment on the market as actually very negative. So as long as we carry forward to 2024 with such a negative sentiment, it's very hard to find any positivity in such a circumstances. So keep that in mind. If you are trading the market, it's going to get very volatile. And I think being in the futures market, it gives you a bit more flexibility in the sense that you're able to short whenever you find that the sentiment has actually been weak, as compared to any other instruments which doesn't give you that much of a flexibility. Now, if you just look at domestic front, there's also a couple of good news in the sense that Malaysia's CPI, if you compare with other rest of the markets, is still quite moderate in certain ways. Keep in mind, although a lot of our commodity space are quite there's subsidies from the government, so therefore that actually will ease inflation, overall inflation numbers. But having said that, I think if you just look at how the commodity performance, if you discount crude oil, if you take out crude oil as part of the equation, the rest of other commodities generally has actually been trending lower. If you just look at palm oil, for example, it was trading as high as 8,000 ringgit per ton last year. Now it's actually doing about below 4,000 ringgit, so it's still manageable. And so therefore, I think eventually Malaysia is in terms of the inflation numbers, has pretty much past its peak. The key thing is all about, the key equation in this regard is about growth. Where do we see the spurt of growth within its own domestic economy? And that's very difficult to assess, given that what we are witnessing right now, both the external front and also the internal front as well. Now, Malaysia is not sitting on a very tight spot. I think it's already Malaysia is sitting on a very tight spot, given that first thing, we have account balances that's actually shrinking. Although we enjoy surpluses, but I think that surpluses has actually been shrinking quite dramatically. And I think the second key part is always about that. Keep in mind, as interest rates across the world starts to increase, eventually our own domestic interest rates will also have to follow suit. If not, then there's always a currency pressure in play. So with such a huge amount of debt, or debt levels that's increasing year by year, year on year, obviously when you have high interest rate environment, the interest of servicing this, or rather the cost of servicing this interest is going to be getting higher. So as a result, country will always have to find ways to search for new revenues, or to increase its balances, or to increase its reserve as a way to counter the high interest rate servicing. So I think Malaysia is in a very tight spot. Obviously, I think eventually, given that's planned as after the budget and implementation of certain subsidies reduction, hopefully, we can find a bit of balance in that. But I think it's going to be very pressuring going into next year with such a domestic structure that's in play. So keep that in mind. I know this may not have an immediate impact when you are trading the market. This may not have much of an impact. But I think if you look at where the trend of the market is, eventually all these domestic factors will play out. And being on the lookout for such factors will eventually help you in determining where the market is going to head. Now, besides looking at crude oil and CPO, which is a very export-driven country where it derives most of its revenue, if FKLI, another major sector is also contributing to its economy is actually also the semiconductor industry. So if you look at the ETF, the semicon ETF, together with FKLI, there's a bit of a linkage here. So you can clearly see whenever the semicon industry don't perform well, that also means that also put pressure for your FKLI as well. So you can clearly see, I think the recent semicon sectors actually be not doing well because the sales overall, the global sales, semicon sales actually been heading for the downtrend. So that spells where FKLI may go. There's a lot of external headwinds that's in play. So really it's difficult for FKLI to be trying to find a rally between itself. With such a major headwind as coming to play, all these will be pressuring factors for the index. Now, this is interesting. If you just look at ringgit against the FKLI performance, generally you can expect that when you have a weaker ringgit, it doesn't boil down, it doesn't bode well for your FKLI performance. When you have a stronger ringgit, obviously, there's a feel-good factor. It will translate into stronger stock performance or equity performance. So you can clearly see where ringgit is heading right now. It's not on a very good territory, and it's definitely going to put pressure on the stock market. And you can clearly see that. So whenever we have a weakness in ringgit, it's actually telling you that there's external pressure in the market, that eventually that will translate to lower stock prices. So that will also be putting pressure for your FKLI index. So if you are trading this market space, you can use ringgit as a one of the factor measurement as to see where the linkage when you trade FKLI with the ringgit is going to hit. So as long as ringgit gets weaker, that will be a limiting pressure for the FKLI index as well. Now, coming to seasonality. Now, I've been trading the FKLI for quite some time, and trading index market, if you compare with trading commodities, they're slightly different. Commodities, when it comes to understanding seasonality pattern, it's actually more clear. It has a clearer picture. For example, if you've been trading CPO, you notice that towards year end, the stronger prices because production tend to be weaker and whatnot. Now, index can be slightly different, but if you just look at all in all, year in, year out, there's bound to be a period where a period of time, especially in the period of the year, where prices tend to be stronger. If you just look at the past decade or so, FKLI tend to do very well, especially towards the November-December period. Now, you can obviously argue December usually is the end of the year. There's window dressing in play. That normally translates into better prices because as fund managers try to close their books, they want to close positively, so they'll try to try to push up the index in a way, and that will probably end the year better than last year. So usually December is a feel good factor. Now, if you notice the sharp, most of the time towards year end, especially towards the fourth quarter, there's also two things to observe. One is higher volatility, and second thing is that the index tend to perform slightly better compared to the rest of other subsequent quarters. So right now we're entering on a seasonally stronger period. Now, obviously, there's seasonality may not come into play if there's other external factors that's having a stronger influence on the index. But as long as if you use seasonality as a way to rely on, we are entering to a stronger period. So during the stronger period, as long as the index is performing well, that shows you there's a high tendency for the market to ride along the trend. But obviously this can change because seasonality does year-to-year change. In fact, if this year the external headwinds are stronger, we could probably end the year weaker than last year. So there's a year-on-year negative. But if you just look at seasonality pattern, it's quite crucial to watch as we enter into a stronger period, whether FKLI can continue to hold its level. Because based on history speaking, I think as we enter the fourth quarter, normally is usually a stronger quarter as compared to other quarters. Now, if you have been trading the futures market, obviously FKLI is tracking very closely with the cash market, the KLCI stock market or cash market as we call it. Now, if you notice, the reason why if the FKLI is usually trading at the slight discount compared to the cash market is because in the index futures market you are able to short. So whenever there is a price discrepancy between the cash and the futures market, it does tells you the sentiment of where the market is heading. So in other words, is that because the futures markets allow you to short, or rather there's allowed certain people to also hedge their position in case of any volatility in the market. So that also bring down the futures prices. So whenever you see there's a big discount, normally what that tells you is that generally the sentiment in the futures market or the next subsequent few months is not going to be good. That's why there's a discount. Keep in mind, futures markets allow you to short, so people can obviously short the futures market. So that will bring down the overall futures prices. So that create a discount or gap between the cash and the futures market. Now, this usually foretells you the sentiment of the market. So if there's a wide discount between both the market, it does indicate to you, in the future, the market is probably trying to factor in quite a pessimistic view of the market. So do take note, now we are seeing the futures market most of the time is trading at a quite a big discount to a certain extent. So I think it does indicate to you there's weaknesses. People are still expecting weaknesses between the index itself. So obviously, I think as long as there's a wide gap between the markets, is something to watch out for if you are trading the futures market, because it does indicate to you the sentiment that's in play. It may not be that positive ultimately. Now, technically speaking, I think FKLI seems to be on the doldrums pretty much for the whole of this year. The 1400 is a very psychological support level or resistance level. If it does cross the 1400, we tend to stay there for quite some time. But if it does break below, usually that spells a downtrend in the index itself. So I think this year, pretty much of this year, if we just look at where the index has been performing, there's been quite a downtrend. We used to hit the 1600 back in early last year, and that we couldn't sustain. And right now we are trying to sustain, barely sustaining above the 1400. So it's crucial to watch, despite if you just plot the longer term moving average with the shorter term moving average, the 50 and 200 period EMA, it does tell you, technically speaking, the index is actually heading on a sideways pattern for now. There's no clear direction of where the market is heading. In fact, there's actually more downward bias for the index. If you just look at some of the factors we considered earlier on, looking at the external markets and also the internal markets, it's actually very difficult to find any positive factors that actually can lift up the index above the 1400. So right now the index is still pretty much on the sideways range of the market. Like I mentioned, if it breaks below the 1400, technically it's actually on a downtrend basis for the whole index. Now, if you are trading the market, there's always two sides of, or rather there's two basic camp of trading strategy. I think one is to look at things on a trend basis. So as long as the market is trending, we are in a position. If you're a trend trader, you are in a position to trade with the trend. Always remember this: if you are a trend trader, if the trend is on a bullish trend, you always must find position for you to long the market instead of trying to time the reversal of a trend. It's always a very difficult proposition to be in if you're trying to time the market. Now, obviously, the next camp is always a mean reversion trading strategy, which usually works well if the market is heading sideways and heading nowhere. So obviously, one of the first thing you need to do is identify the trend of the market. There's a lot of ways to do it. One of the ways, if you just look at the previous chart, you can obviously plot EMA lines, moving averages, which pretty much smoothen the fluctuation in price. So as long as the candles are trading below the longer term and the shorter term moving averages, it's telling you the market is downtrend. If it's trading above both the lines, it's telling you the market is uptrend. And if it's trading both, if the lines are flat and the candles are also going nowhere sideways, it's telling you the market is actually heading sideways market. And in sideways market, it's not to say you can't do trend trading, you still can, but you just have to use a smaller time frame. So eventually, I think most of the trading styles are depict in these two type of trading basis. Either you are a trend trader or eventually you are a mean reversion trader. Now, if you are, I'm for myself at one bit is looking at trends. So I tend to use often trend strategies that try to indicate where the trend on market is. Now, if I just depict two particular chart here, you have chart A and chart B. Both of them are the same product, same time frame, and the same period of time. Now, if I were to ask you, if you're a trend trader, which chart will you be relying on? Which chart of you, which chart gives you a better signal when it comes to trend trading? Is it chart A or chart B? Maybe I'd just like to hear some responses from the audience. If you think that chart A gives you a better picture of a trend, or whether chart B gives you a better picture of a trend. Maybe I just want to hear some responses. You can just type the responses in the chat, and probably want to gauge where the audience see when it comes to trend trading. Yeah, I can see some responses. I think majority of people, when it comes to trend trading, they tend to choose chart B. Now, both chart A and chart B, they are also based on the same principle of Japanese candlesticks. The only major difference is that chart A is actually a normal Japanese candlesticks. Chart B is a derivation of one type of Japanese candlestick. It's called Heiken Ashi. Now, Heiken Ashi is widely available on most charting platforms. You can get it on TradingView or any other charting platform that's available on outside. The reason Heiken Ashi is simplifies to you the trend in certain ways because it's actually taking the measurement of the Japanese candlesticks and taking the middle bar. So in a sense, if the Heiken Ashi shows you a downtrend, actually you are staying in the trend longer than just by looking at Japanese candlesticks. So Heiken Ashi is a very good tool if you are looking at trend trading. Now, I think one of the major benefit of using Heiken Ashi as compared to normal Japanese candlesticks is Heiken Ashi. There's three distinct patterns, and you just have to understand these three distinct patterns. If you use Japanese candlesticks, there's various configuration. I think there's 100 over configurations. It's not easy task. So if you want to understand where the trend on the market is, I think Heiken Ashi can tell you quite directly. So as long as the candles are red, it tells you the market is bearish. And if the candles are green, it tells you the market is actually bullish, trending upwards. So as long the body of the candles are also equally very important. If the body candles are white or big red or big green bars, it tells you that the trend is the strength of the trend is very strong. If the bodies are very small, almost like a doji, it tells you probably the trend is exhausted or the market is heading sideways. And if you see a series of green and red candles side by side, especially after a downtrend or uptrend, it tells you pretty much the uptrend and downtrend is peak. It's probably there's time for reversal very soon. So Heiken Ashi is very distinct pattern in this regard. So it does indicate to you how the trend on a particular point in time works quite closely. Now, obviously, the major difference between Heiken Ashi and Japanese candlestick is the major forms itself. Heiken Ashi, there's only 3 major forms. Japanese candlesticks, like I mentioned earlier, there's so many combinations, and the combination must be very specific. So it can be, the 3 white soldiers or the morning star and all this. The combination of it must be very precise. So it tend to get quite complicated. And Japanese candlesticks, the interpretation, especially the configuration, is very subjective in nature. To some people, they may see a morning star formation. To some people, they may see other type of formation. So it's very difficult to get it standardized. But Heiken Ashi is actually very simple. You know, it's very standard in the sense that by the color of the bar, and you know, Heiken Ashi is actually based on a particular formula. You can obviously go and Google it. So if you are someone that is doing automated trading, definitely you can use certain formulas to actually quantify Heiken Ashi, and from there you can automate the trading strategy accordingly. Now, Heiken Ashi is very trend following, so it keeps you in a trend longer. Japan candlesticks, usually it comes to more of a reversal pattern. So you're trying to time where the doji is, you want to, and that usually when the doji appears, that will usually be a reversal in the trend. Heiken Ashi always is trying to tell you where the particular trend is still heading through by the color of the bar. So in that regards, it's actually easier for you to identify trend using Heiken Ashi as compared to using Japanese candlesticks. So just to show you the dynamics, so you can clearly see here the bright big green bars in Heiken Ashi does indicate to you there's an uptrend in place, and usually it's very strong if the body of the bar is white. Same goes for here. If the bars are red, that usually tells you is a downtrend in place. And if the body of the candle is very white, that tells you the strength of the trend is actually quite strong. So keep in mind, if you see a series of red and green candles and the bodies are very small, it does tell you the market is heading sideways. So in this regards, you know, if you are holding to an uptrend, it's time for you to get out. You know, if you are holding on a downtrend, you see there's a series of candles appearing, that tells you pretty much the downtrend is exhausting. So it's time for you to get out of the market as well. If you see such a very small body candle, it tells you the market is heading sideways. There's not much of direction for it to push it either upwards or downwards. Now, just by using Heiken Ashi can be a quite difficult task, especially to pinpoint entry and exit strategies. So I think you can obviously couple that with moving average crossovers. Moving average crossovers are very simple. You just plot the two different period of moving averages on the chart. One usually is a longer term, usually denoted by 20 period. Another one is a shorter term, usually denoted by 9 period or 10 period EMA. So when you have a crossover, that means usually it's the shorter term crossing below or crossing above the longer term. So if the shorter term is crossing below and you will see a red Heiken Ashi bar as circled here, that usually tells you that the market there's a potential downtrend in place. One is the first indication of the red Heiken Ashi bars, and the body of the Heiken Ashi bars are white. And the second indication is there's a bearish crossover in the moving averages. So with these two regards, you probably can get a good signal for you to be entering a short position in the market. So same goes for here. So long position is otherwise you have a bullish crossover on your moving averages and you have a green Heiken Ashi bars. So when you see that, that normally tells you there's a possible uptrend in place, and you just follow according to the Heiken Ashi bars. Now, the reason I'm also sharing with you on the DMI, which is a classic trend indicator tool, if you look at DMI, the configuration of DMI, you know, it's all about looking at the price momentum. So if the positive price momentum, which is denoted by plus DI, and the negative price momentum is denoted by minus DI. So DMI is a very good indicator to tell you the strength of the price. So if you see the positive DI crossing above the negative DI, it tells you the upside price or the price momentum is on the upside. And if we compare that, if you get a signal on the bullish crossover and your green Heiken Ashi bars, that's actually quite a good signal for you to take. Now, same vice versa, if you see a negative DI crossing below the positive DI, it tells you there's a strong negative momentum in price. And if you can get a clear signal based on your Heiken Ashi bars and a bearish crossover on your EMAs, that's a pretty good signal to take for you to short the market. Now, the reason why in most instances I don't use both together, because the moving averages crossovers is very similar to the DMI signals. So there's a bit of overlap. You know, as a trader, you want to make your decision fast. So you don't want to make your decision too late. So if you have too many indicators on the chart, normally that will tell you you need some time to wait for the signals to appear. So if you have lesser indicators on your chart, it's the faster you can make the decision on your entry and exit signals. Now, the reason why DMI is also used as a measurement of trend strength is also because there's a part of the DMI indicators, we have a ADX line, which is, or whether it's an ADX value. So what this ADX value tells you is that very simple. If you see a downtrend in the market, where it's a red Heiken Ashi bars and a bearish crossover, and you see a rising ADX, which is the black line, is also part of DMI indicator. It does tells you that the strength of the downtrend is getting higher. That means the downtrend is fierce. So if you are in the short market, you prepare to hold a short position until either the ADX starts to decline, which means as from 50 value it went down to about 40 or 30. That shows you declining ADX value. When this happens, that normally tells you the strength of the downtrend is actually weakening. So it's actually time for you to get out of the market, or it's also signaling to you that the downtrend is probably going to be exhausted, and probably the market is going to hit for a sideways pattern for a while. So ADX is a very good measurement when it comes to measuring the strength of the trend. It's important for us to measure the strength because if you see an uptrend, if the strength is very weak, normally expect the uptrend tend to not last for quite a long period of time. So you have to be careful when you look at trends. So ADX is a very good indicator for us to gauge where the strength of the trend is. As long as the market is on a particular trend, index value is rising, that tells you you're actually good. You are safely riding the trend because the strength of the trend is still quite prevalent. Now, ADX value, anything that's above 20 is a very common guide. It does tells you the market is trending. If anything is below 20, it tells you the market is sideways. Keep in mind, DMI, or rather Heiken Ashi and even moving averages, these are all trend indicator tools. So if you are trading on a market that's sideways, it's actually time for you. You should be using other mean reversion tools when you trade a market that's heading sideways. If you use a trend trading strategies on a sideways market, you tend to get whipsaw quite often. Now, just to show you a particular entry strategy, what you have here is that you have a cluster of green Heiken Ashi candles, and you have a slight bullish crossover in your EMAs. And if you just look at DMI, you start to see the positive DI crossing above the minus DI, which does indicate to you there's a positive momentum in price. So actually here is a very good signal for you to take a long position. Now, I think last but not least, when it comes to tools, we are always very fixated on thinking where to enter a particular point or particular price based on a certain strategy. But it's also equally or more important for us to make sure that we have a plan for you to exit in case the market go against us, which is very often the market can go against us. I think one of great tool for us to measure your stop loss level is what we call ATR, which is also part of a trading tool. It stands for average true range. Basically, it measures the true range of a particular day. So the reason why we use ATR as a measurement, because if the market gets volatile, so ATR value will increase. Basically, the range of the day will increase. So therefore, to measure your stop loss based on ATR, in other words, your stop loss will also have to be increased because the range of the day has increased. In other words, it doesn't stop you out so easily, especially when you place stop loss as so tight, and it adjusts according to market conditions. So I think having ATR as a tool to measure your profit target and stop loss level is a great tool, especially when markets start to expand. That's where you really be protected. So importantly, we can't just be fixated on trying to target profit. We also must make sure that we have a plan in place whenever things goes wrong. So I think one of the great ways, great tool that's available is to look at ATR. So the way to look at it is that if you have a long signal, you long a particular price, and the ATR value at that point in time is, let's say for example, it's 3 index points, and you work on a reward to risk ratio of 2 to 1, that means you're looking at 6 points as a reward. Risk is pretty much limited to 3 points. So this is how you work on ATR. And all trading plan, we must be disciplined enough to execute our rightful profit target and also the rightful level of stop loss. There's always the amount of discipline that's involved, especially when you look at your trading plan. Obviously it's actually very tempting when markets are in your favor. You tend to let the reward right, but you don't adjust your risk accordingly. I think that's where it's very dangerous, because at the end of the day, trading is all about risk management. If you get your risk management right, your profit will be always be secondary. The key thing is always manage your risk. Now, so this is what happened next. I think pretty much your profit target level is hit quite instantaneously. But the key thing is that the uptrend is still quite intact. So keep in mind, if you just look at the ADX value, it has been rising. Green Heiken Ashi bars are trading well above your moving averages line. It does indicate the uptrend is still quite intact. So obviously there's a lot of opportunity for you to go along or try to ride along the trend. But a plan is a plan. If it hits your profit target, you should be out and you look for the next best opportunity for you to be getting into the market again. Now, obviously that's why it's very tempting, for us. If you just look at Heiken Ashi bars and the moving averages, you can always ride until the bars, the Heiken Ashi bar starts to turn. That's one of the alternative way for you to exit. Or if you just look at the DMI as a very good indication. As long as the positive DI is riding above the minus DI, that's also an alternative way for you to try to ride the trend. But then again, if you already have fixed profit target and a stop loss level in place, stick to that plan. Then recalibrate to your next plan for the next potential trend in the market. Now, just another trade example. I think this is what we call a quite clear-cut red Heiken Ashi bar is forming, because the body of the Heiken Ashi, the red Heiken Ashi bars are quite wide. So it does tells you that the downtrend is starting to appear and it's actually gaining momentum. Why do I say it's gaining momentum? Just look at ADX value. It's actually rising above the 20 index value. So it tells you there's a trend in place. So your ATR at that point in time is 3 index points. So basically, the way for you again to set your profit target and stop loss level is actually based on ATR value. So if your ATR value is at 3 points, if you're short the market at 14.25, so you're looking at 6 points as your profit target and your 3 points as your risk per level. Now, keep in mind your reward to risk ratio always varies with individual. Now, 2 to 1 is a very standard default way of looking at it. Some traders may have a much lower ratio level, some may have a higher ratio level. But always remember this, the stop loss or risk level is always synonymous with your tolerance. If you can't tolerate a big risk amount, so make sure you have a very low reward to or high reward to low reward to risk ratio, or a reward to risk ratio that is comfortable to how you see or perceive risk. If you're someone that can't tolerate risk that much, so make sure you adjust your reward to risk accordingly. So I think just to summarize, when it comes to creating a trading plan, I think the first thing is always to look at the overall trend of the market. If the overall trend of the market is trending upwards, try to ride with the trend and not against the trend. So I think that's the key message. You are a trend trader, you always try to ride against the bigger trend of the market. It's always a difficult business to be in, especially try to pinpoint where the reversal of the market is. I think the second thing is that you can use tools like Heiken Ashi and moving averages quite smoothly. If you incorporate both these two indicators together, you get quite a good trend strategy that you can use. And pretty much, I think in most markets. Now, obviously, you got to back test accordingly. Whether the time frame that you're using it varies accordingly with the results. So make sure that you do your back test accordingly, especially with the trend strategy that I just mentioned. Now, DMI is also a great tool, but it's more towards measuring the strength of the trend. DMI is a very good trading tool when it comes to looking at the strength of the trend. As long as the ADX values are rising, especially during an uptrend, it tells you generally the strength of the uptrend is still intact. Importantly is to look at ADX value when it starts to decline, especially in the uptrend or downtrend. When ADX value starts to decline, it does tells you that generally the trend of the market is softening. So if you're holding to a certain position, you have to be on the lookout. Now, ATR is used mainly for risk management. Like I mentioned, if the market is expanding in terms of volatility, that generally tells you that you have to adjust your stop loss accordingly. So the key disadvantage of using ATR to manage stop loss is that you have to prepare. If the market gets more volatile, you have to prepare for bigger stop loss in place. So that's because you are using based on an ATR value. Last but not least, I think it's always important for us to journal your trades. accordingly. I know this is always a tedious thing, especially for newcomers. If you're new to the trading business, it's always very tiring after a day of trading to journal your trades accordingly. But this is important because ultimately it tracks your performance accordingly to make sure that you're actually on the right path. Now, so if you just look at it, the reason why FKLI is considered one, if you are someone new to the market, FKLI, is quite a good market to trade with, is because the volatility, the daily volatility of the market or index itself is actually quite low. If you look at the peak back in the COVID-19 pandemic, the daily range is about 50 points. You just look at Dow Jones during the height of the pandemic, the daily range is almost 2,000 index points, which is quite substantial. So in other regards, I think FKLI, when it comes to index points or volatility of the nature of the product, is actually quite low. So for beginner, it tends to be very a good product to start off with because of the nature of low volatility. So it does help you to understand how the market works, and hopefully it can fine-tune your strategy with a lower volatility product. Now, if you compare with CPO, it's slightly different. CPO has a greater volatility on the daily range. So in that regards, if you compare the risk on risk comparison between both products, obviously the FKLI tends to stand out as a lower volatility instrument as compared to the CPO market. Now, I just touch a little bit on the contract specs. So FKLI, one index point is actually 50 ringgit. And you move on a half an index point, which is 25 ringgit. And the key thing is that it's a futures product. Futures product gives you a lot of edge in terms of flexibility. So if you have a view or you want to express a view that is negative to the market, you can obviously take a short position on the index futures market. And given the fact that futures market also involve different calendar months that is on the future time, that allows you to take a view or a position in a future time as well. So if you're thinking that next year is going to be a tough year, it's going to be a volatile year, you can actually express your view based on the futures contract that's available for next year at this current juncture. And I think if you just look at the trading hours, the FKLI is actually trading at 15 minutes earlier than the cash market. So it allows you to adjust yourself accordingly. And I think right now with the introduction of the T+1 session, the night trading session, is also crucially quite important in the sense that, especially when US market starts to have a lot of news flow coming into the market, especially off Asian hours during the night time, with the futures market, the night futures market that's available for trading, it actually allows you to capitalize on certain opportunities that usually the cash market is not available at that point in time. So in that regards, futures markets gives you a bit more flexibility when it comes to timing as well. So I'm just going to end it here with a quote. So if you are if you don't know who Alexander Elder is, he's actually one of the great trader. You can obviously go and Google about him. I think he's always mentioned this phrase, which I think is very timely and actually quite put the trading journey quite pointedly, is in the sense that the goal of a successful trader is always to make the best trades. It's never about the money, because if you put money as the primary motive or motivation for you to be a trader, in most cases it always fails you in certain ways. So I think the main motivation for a trader is to make sure that he or she execute the trading plan accordingly with much discipline. And I think if you do that right, money will always be something that you always flow quite easily once you get the ingredients right, the process right. So with that, I'm just going to end here. I'm just going to pass it over to Abigail for any questions from the audience.
Yeah, all right. Thank you, David, for an informative session. There was really a great insight into the global economies and the correlation between markets, and you also brought on a lot of useful indicators and tools that our audience can use for the technical analysis and their entries and exits. So yeah, now we will go into the Q&A session. So yeah, if you all have any questions, do put inside the box. And let me see if there are any questions. Okay, so we have a question. Okay, this is regarding the futures, crude oil and also gold. So the question is, can crude oil and gold maintain the trading in its bullish direction? He's referring this to the December contract specifically because it looks like the prices are going down. So what do you think about this, David?
Okay, I'm just going to address the question on crude oil first. Now, if you just look at what is happening on the crude oil front, there is obviously geopolitical tension that is actually causing a lot of havoc in the crude oil space. Keep in mind, if you look at the fundamentals of crude oil, the supply and demand dynamics of crude oil is actually very tight. That means the supply is actually very tight. These are artificially, they make it tight. With OPEC country, especially the Saudi Arabia and Russia, OPEC plus, they decided not to release more supply into the market. It's actually trying to strangling the market with limited supply. But you have, on the other hand, another equation. If you just look at what I mentioned earlier part in the webinar, global economy is not going to perform very well with sluggishness from China and all this. It's going to affect the demand equation as well. So really, I think for crude oil prices, it's going to stay quite elevated, but the upside is also quite limited. Now, there's a big risk to that is mainly the geopolitical tension that's in the Middle East. If it gets more intense, if it's spread, definitely you're going to see another rally in crude oil price. Keep in mind, crude oil is very geopolitical. It's very political in nature. So whenever there's big political play, normally it will move crude oil prices. So that's what I'm saying. This is very difficult for crude oil price to fall below $80 per barrel because the dynamics, the supply dynamics is just very tight. But on the other hand, the demand equation is also getting weaker. So I think it's basically an interplay between both factors. Now, coming back onto gold, if I get the question correctly, is it talking on gold, Abigail?
Yes, gold.
Yeah, gold is also a very political play. The funny thing is that, gold as an asset class, the funny thing is with such a high interest rate environment, normally people would not like gold because gold doesn't pay you any interest. You hold gold as an asset class, it doesn't give you dividend, it doesn't give you interest. So when a high interest, people will not look into gold. But the funny thing about now is we have a political situation which always begs the question, gold as a role for safe haven. I think that remains still very relevant. So as long as there's political crisis happening around the region and it will intensify, people will still rush into gold. So I would say both these asset classes, they are very politically in play. Going into 2024, and especially on the December contract, which is quite an active contract, as long as political tension is still rising, there's still a bit of upside in both these commodities.
All right, thanks, David. I think this is another question. It's a bit similar to what that was asked regarding crude oil. So yeah, this question is asking your view on the Israel war. Could it, possibly get out of hand and make the crude oil go up to USD 150? Do you think that's possible?
Now, I don't want to say that's impossible. I think any market situation is possible. Even look at crude oil, it went to negative. That's people say it's impossible, but it does indicate to you it's possible. Now, I think going back into the Middle East crisis, I think as long as it doesn't spread, it's well contained, and the pressure starts to ease, I'll probably crude oil price will also start to ease. So again, crude oil is very politically, it's quite political sensitive commodity. So as long as it doesn't spread, probably crude oil price can contain. But if it does spread, then we might have an issue. And there's a possibility that it could easily breach the $100 mark if the crisis does spread. Because keep in mind, the supply and demand dynamics of crude oil is actually very tight. Like I keep emphasizing, the supply is quite artificially being tightened by OPEC. So they are not releasing more supply into the market. is trying to maintain quite a high price. So if there's always something, especially political crisis, that can spark a next view in crude oil price, is actually a very likely scenario. So that's how I put it.
Okay, thanks for the insight. And then we have another question here regarding the contract spec. So the question is so there's a T+1 FKLI which trades until 2:30 a.m., right? And then CPO is until 11:30 p.m. Is there a reason why there is a difference in the time for the T+1 session?
Good question. I think probably probably can direct someone from the exchange will be a better person to answer that. But I think in my opinion, the reason why there's a CPO traded close or rather ended quite earlier is mainly is also to make it in line with where Thailand night market is. Thailand is also quite a big market when it comes to the palm oil space. Although their product is slightly different, they're trading on the palm oil futures. We are trading on the CPO. So day closes at about the same time for the night session. So we try to make it in line. So whether will that in future there's plan to make it all closer at the same time, that I'm not sure. But I think that mainly why CPO is also mainly one of the factors is you should try to make it in line with other markets as well.
Yes, correct. All right. Okay, so another question here is what's your view on NASDAQ index in the fundamental perspective and also the technical perspective?
Okay, I don't have a NASDAQ chart with me, so I can't give a technical view. I think in terms of looking at it, fundamentally speaking, NASDAQ is, if you just compare with other index, other major US indices like the US Dow Jones or the US S&P 500, NASDAQ tend to outperform. Actually, it has been outperforming for quite some time. Keep in mind, NASDAQ are very tech-driven companies. So tech companies has always been the theme for quite some time for the market. So as long as they are still recording healthy profit, healthy growth, NASDAQ will continue to outperform. But keep in mind, tech companies, most of the tech companies are quite overvalued. So when you have a high interest rate environment, and you have softer economy, normally those companies that have a very high valuation will start to plummet quite substantially. So the way I look at it, NASDAQ, as long as the tech companies can continue to outperform, the NASDAQ itself can do well and still outperform other major US indices. But as the moment when this company starts to soften in terms of their earnings and growth, I think that's where crucially NASDAQ will probably feel the pressure.
Okay, thanks, David. And I think we have a last question here. This is regarding the FKLI. So this is the question. It says that FKLI seems bearish. So what is your view in terms of the sentiment, the market sentiment? Is the momentum strong now, or based on your momentum indicator? Yeah, is it more towards bearish or how? Yeah.
Okay, based on the indicators I showed to you currently, if you just look at where moving averages is, the market is still trading, on the downtrend basis, still trading below the 50 and 200 period EMA. That it does tells you the market is on a downtrend. The only crucial part is that the 1400 psychological support still holds. Now, going forward, 2024, there's a lot of external headwinds. We have a softer global economy. We have obviously a lot of domestic issues to resolve, and obviously, with so many uncertainty that's we are heading into so many uncertainties, there's a lot of pressure. So overall, I think the sentiment of the FKLI market in particular still seems to be a bit bearish. But keep in mind, there's one slide mentioned earlier on seasonality. The seasonality always points towards the year end. It tends to perform better compared to other quarters. Whether this coming quarter we are in, is it going to be the same? Does the seasonality comes into play? It's still much to be seen. But if that's the case, I think probably we could expect probably a small rally that could come in place probably end of this year. That probably coincide with the last window dressing of the year, which is quite in line with seasonality. But then heading into 2024 will be quite crucial. With so many external headwinds, I think that will really pressure the markets.
All right, thanks for your answers, David, and thank you all of the audience for participating in the Q&A. So that was the end of our session for Q&A. Okay, so yeah, just before I let you all go, I've just some information for you all as well. So if you guys are keen to connect with us, you can find us on these platforms. You can just search Phillip Capital Sdn Bhd on our Facebook, YouTube, Telegram, and also LinkedIn and Instagram as well. So yeah, we have a lot of updates regarding our events, our promotions, and also do post some market news and also updates there. So yeah, be sure to follow us so you don't miss out on any updates and promotion that we will have. Yeah. And then our recorded videos will also be uploaded on our YouTube channel as well. So do check them out. All right. And yeah, this is the branches our different branches for you to contact, right, depending where your location is. So yeah, you can visit or contact our branch nearest to you. And yeah, you can also take a screenshot if you want to. If you have any inquiries, you can feel free to call us or drop us a message anytime. All right, so yeah, that is all for our webinar tonight. I really appreciate everyone for your time to join, and also thank you, David, for your time and sharing once again. So we hope to see you in our events, right? Thanks, David. Thank you.